All right, let's get right into it. As of 9:39 a.m. Eastern on this Wednesday, November 5th, shares of Pinterest, ticker PINS, are in an absolute free fall. The stock is trading live at $26.95 per share. That is a catastrophic drop of $6.75, or just over 20%. From yesterday's close. This is a massive, violent, high-volume rejection by the market, and it's happening right as the opening bell rings. This isn't a slow bleed, it's a gut punch. And the immediate glaring question is why? Why is a company that just reported what, on the surface, looked like a blowout quarter getting vaporized? This is the perfect example of the tension between the narrative and the numbers. The expectation, the story everyone was telling themselves about Pinterest yesterday, was that this platform was finally hitting its stride. Last night, after the bell, they dropped their Q3 2025 earnings. The headlines were fantastic. Revenue was up a strong 17% year over year, hitting $1.049 billion, right in line with forecasts. They reported $92 million in actual GAAP net income. And the big one, the metric everyone watches, they announced a new all-time high of 600 million global monthly active users. That's a 12% jump from the prior year. Record revenue, record profit, record users. By all accounts, that should be a victory lap. Many investors, perhaps doing their self-investing or checking their SoFi Invest app this morning, probably expected to see a nice 5 or 10% pop. That was the expectation. Here is the reality. The stock is down 20%. The market is telling you in no uncertain terms that it does not care about the 600 million users. It does not care about the 17% growth last quarter. What it cares about, what traders at firms using interactive brokers and Fidelity are slamming the sell button on, is the guidance, the future. Management's forecast for the all-important fourth quarter, the holiday shopping season, was a massive disappointment. Pinterest guided for Q4 revenue to be between $1.313 billion and $1.338 billion. That sounds like a lot, but it represents only 14 to 16% growth. The buy side, the big institutions, were expecting, on average, a guide of 16.9% growth. That small gap on paper is a chasm in reality. It signals a slowdown. And if there's one word the market hates more than anything, it's slowdown. Compounding the pain, their earnings per share, the actual profitability, came in at 38 cents, missing the 43 cents analysts had penciled in. So the narrative of a perfect growth story just hit a brick wall of weaker than expected reality. This is the kind of day that tests your entire thesis for an investment. The common belief about Pinterest is that it's the nice social media platform. It's not about politics or divisive content. It's a visual discovery engine for inspiration, home decor, fashion, recipes, travel. It's brand safe, which advertisers are supposed to love. It's seen as a cleaner alternative to its competitors, a place where users are in a buying or planning mindset, which is the holy grail for advertisers. People using the Robinhood app to buy Robinhood fractional shares might just see it as a popular app, but institutional holders see it as a direct pipeline to consumer intent. The platform has been pushing hard into e-commerce, turning those pretty pictures into shoppable pins and shop-the-look features. The 600 million user number proves the inspiration part of the model is working better than ever. But here is the challenge to that common belief, the hard truth being delivered today. Pinterest is not as insulated from the real world as that narrative suggests. The reason for the weak Q4 guidance wasn't that people are leaving the platform. It wasn't that the tech is broken. On the earnings call, management specifically pointed to tariff-related weaknesses impacting its advertising business. They noted a domestic revenue slowdown. Let's translate that from corporate speak. What it means is that Pinterest's core advertisers, the ones spending big on the platform, think home furnishing companies, high-end retail, fashion brands, are getting squeezed by the economy. They're pulling back their ad budgets because their customers are slowing down. So Pinterest isn't just a tech or social media stock like Apple stock or Tesla stock. It's a highly sensitive barometer for high-end consumer discretionary spending. And that barometer is flashing red. The 600 million users are great, but if the average revenue per user can't grow because advertisers are scared, the user number is just a vanity metric. This is causing a scramble on Wall Street. Analysts at RBC Capital, Guggenheim, and UBS all rushed out notes this morning, and it's a fascinating consensus. They all lowered their price targets. Guggenheim, for example, slashed its target from 44 down to 38. But, and this is the key, almost all of them are maintaining their buy ratings. This is the classic, we still believe in the long-term story, but the next 6 months are going to be ugly position. They're acknowledging the retail headwinds and the tariff impacts. They see the same problem we do, but they're betting that the platform's new AI-powered shopping features and the long-term potential of monetizing that massive international user base will eventually win out. Today, however, the market isn't in a long-term mood. It's reacting to the now, and the now is a guidance miss and a margin squeeze. This is precisely why managing a portfolio, whether it's an individual brokerage account or one of the Schwab Intelligent Portfolios, is so difficult. You're constantly weighing a bruised-up present against a promising but uncertain future. Let's look at the institutional activity, because on days like today, it's the big fish that move the price. We know from recent filings that institutions own the vast majority of this company, well over 75%. The top holders are the usual giants, the Vanguard Group, BlackRock, but interestingly, an activist investor, Elliott Investment Management, is also one of the largest shareholders. This heavy institutional ownership is a double-edged sword. It provides stability when things are good, but when a company misses guidance, it can trigger a stampede for the exit, as all these large funds who have access to the best Fidelity trading platform or Interactive Brokers platform try to reweight their positions at the same time. This is what you're seeing this morning, a flood of sell orders from funds that can't afford to wait and see. What's particularly interesting is that while these funds are selling, recent data also showed that Pinterest's own management has been aggressively buying back shares. That's a huge conflict in signals. Management is saying the stock is cheap. The market is saying it's not cheap enough. So what does Pinterest even do? For anyone who isn't one of its 600 million users, it's simple. It's a digital bulletin board. You find an image you like on the internet, a recipe, a piece of furniture, a travel destination, and you pin it to one of your personal boards. That's the core discovery loop. The business model is built on top of that. First, advertising. Brands pay to insert their own sponsored pins into your feed, hoping you'll see their product while you're in that planning mode. This accounts for the vast majority of their revenue. The second, and more important for the future, is e-commerce. They've been building tools for years that allow you to click on a pin of a lamp, and instead of just saving the picture, it gives you a link to buy that exact lamp or visually similar ones from retailers like Target or IKEA. This is the big promise, closing the gap from "I love that" to "I just bought that." This is what separates them from other platforms. They're not just selling eyeballs, they're trying to sell a direct path to a transaction. This is a very different game than what we see with NVIDIA stock and its hardware dominance, or Tesla stock and its manufacturing narrative. Here's a question for everyone watching, and I genuinely want to see your thoughts on this. Comment below. Do you think these tariff headwinds and retail weaknesses that management blamed for the weak guidance are a temporary excuse, or are they a sign of a much deeper structural problem for Pinterest's advertising business? Is this a 6-month problem or a multi-year problem? Looking ahead, the path for pins is now incredibly fraught. The bull case, the argument for buying this dip, rests on a few key pillars. First, the 600 million MAUs. You cannot ignore that number. The platform is sticky, and it's still growing, especially with younger demographics like Gen Z. Second, the push into AI. Pinterest is rolling out new AI-driven features for personalized shopping, which, if they work, could dramatically improve conversion rates for advertisers and make the platform indispensable. This is the long-term story the analysts at Fidelity are hanging on to. People using Fidelity mutual funds or Fidelity ETFs that are growth-focused likely have exposure here and are banking on this turnaround. The bear case, however, is what's winning the day. First, that macroeconomic sensitivity is no longer a theory, it's a fact. The company's fortunes are now visibly tied to the health of the high-end retail sector, which is in a very tough spot. Second, competition is brutal.